Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN Sunday for Sunday, September 19th, 2021. We've got another great show for you today. We've got members of the media, academia, and financial services joining us to analyze all the news and the information for the week in retirement markets, technology, personal finance, so much more. So sit back, relax, and enjoy this episode of BRN Sunday. All right, we're going to kick things off with a look at what's going on Capitol Hill, legislatively, regulatorily, if that's even a word, and litigation-wise. I couldn't figure out how to convert that.
Jeff, litigationally.
Litigationally? Okay. You can hear them. They are on the show. You know, we don't mince words on this program. You're going to hear all the back and forth with the exception of what happens in the green room. I'm talking about who's joining us. David Levine, Kevin Walsh, both are principals with Groom Law Group, an employee benefits law firm based in Washington, D.C., and you know them as the Legal Eagles. Gentlemen, thanks so much for joining us on the program this morning.
You know, it's great being on, and I'm going to keep this intro short because now that we have gotten into the fall, things really are heating up both regulatorily and on Capitol Hill. We could talk for weeks on end about what's going on Capitol Hill, but so this week we're going to focus on one piece of it, which is the changes that are being proposed to the IRA system. David?
And Kevin, I got to admit, you could have said Capitol Hillily to realize we keep going with the Lees this morning.
Really?
Seriously? But yes, obviously we need to turn to that. So I'll start off. Kevin, I'm sure will chime in as always. So what's going on here today? Well, Congress, big infrastructure bill, the second infrastructure bill, however you want to call it, reconciliation. We've talked about that before. They are looking.
David,
yes.
Folks are calling the first infrastructure bill the BIF at this point, which is the bipartisan infrastructure. And then this is the DIF, the Democratic infrastructure bill.
Okay. Biffly, diffly, I'm setting a lead to everything today. But moving back to the substance for the moment, really what we're talking about is they're looking for money in couch cushions at this point. And as many of you know, there was a lot of publicity about so-called mega IRAs out there. We're not going to talk about all those mega IRAs because there's always a reaction situation. And what's happened is after all that press, now we've had the revival of something that truthfully began years and years ago. It had some belief in parts of the Obama administration about capping retirement savings in 401k and IRA. So what does this mean? It means they're talking about putting in a rule that's basically no more money after $10 million have gone in to an IRA 401k combo. And in fact, at different thresholds, you may actually have to start taking your money out of your IRA to actually keep it below threshold like $20 million. What does this mean to the average person? Because you're probably saying, that's great. I wish I had $10 or $20 million. Well, before you get so blasé about it, it's the introduction of caps. For a long time, we have been trying to move the retirement system to make sure people have adequate savings, to make sure people do save. And instead, this is like a rollback to the early 90s where they cut limits on could-be plans. And also people have relied on these things. Why should you care? Well, take, for example, the situation of a small business. Someone starts their business in their 20s and it's successful and they max it out year over year over year. If you look at those numbers, by the time that someone in their 50s, especially if they do something like an employee stock ownership plan, they could be sharing the wealth with their employees, but they could actually be capped out on what you could do in proceeds from like an ESOP and other types of investments. So where this leaves us is it's the introduction of caps, and it sounds, oh, nobody would hit that. And you're right, there's not a gigantic number, but the people who put in plans are the one for their companies are the ones who are starting to get hit by this. And it also sort of runs against the idea of let's make sure people have savings. So there's a lot of pushback coming from different corners of the industry. You know, some people are saying, I can live with it. But I think what we're hearing from different corners of the industry, especially in the IRA space where people have planned their businesses or done rollovers to their IRAs of proceeds of things, they're like, wait a minute, I relied on this. How do I go back? And it's very disconcerting. and something we really need to think about. Kevin, do you want to talk about sort of even the more weedy and nuanced items that are coming up?
Yeah, I mean, and it's worth. I mean, I don't want to be sound advocacy here, but I mean, we all talk about the retirement system and how important it is to save for retirement, and the provisions here that affect IRAs really undercut the idea of getting to a secure retirement. If you're a listener, if you have people who you talk to about these issues, it's worth highlighting them. And this is a particularly bad week for Congress to be going after retirement savings because, Natixis Investment Managers just released their 2021 Global Retirement Index study, and the U.S. dropped down to 17th in retiree well-being. And their survey shows that 41% of respondents, 46% of millennials, 45% of Gen X, and 30% of boomers say they'll need a miracle to retire securely. So, I mean, it seems like we're at a moment in time where folks are nervous about their retirement savings, and having Congress now taking steps to cut back people's ability to get to a secure retirement is particularly dangerous. And the caps that David talked about, there may be some sympathy for them, or they may be viewed as applying to others, even though in the long run they could have an impact on most of us or most people. But the two provisions that I'm going to talk about briefly really do cut to people's ability to diversify and achieve a secure retirement. So in addition to go on, Jeff.
No, I was waiting for you to finish, and I'm not going to put you guys on the spot in terms of the crystal ball, but just going back to this, look, the negotiation in Congress, gentlemen, and you know this better than I would, it's a back and forth. They test things, right? And they get public sentiment, and they get lobbying efforts by certain constituencies. So this is not done, but these are things that are being batted around. I just trying to make sure the audience understands that this is not a done deal. This is kind of part of that back and forth that happens anytime legislation of all types is created.
So Jeff, I agree with what you're saying, but I think we're well past the batting around stage. This is a reconciliation bill.
Okay.
So they're looking for 50 votes in the Senate. It's going to be forced through the House at some point in the next few weeks. And the name of the game here is they want to pass something because the Democrats have indicated they really believe that a Build Back Better package is needed. Mm-hmm. And so, yes, there are opportunities for changing this, and we're aware of a lot of those efforts. But because something's going to get done, there's a higher likelihood that stuff will be left in the bill than there is if there's a high likelihood that nothing gets done. I mean, my take usually with legislation is bet against anything happening. But here, I mean, the president spoke on Thursday about how this is a top priority, this piece of legislation.
Okay, fair enough. And then, gentlemen, not to change the subject completely, but I noticed in reading some news stories this morning, there's potential challenges or changes to taxation of exchange traded funds, and I would imagine that this is all part of the same conversation, not part of IRAs, which we're talking about today in the retirement system, but ETFs and other financial instruments deserve or get a little bit more tax favorability as well. So this could be another example where they're looking for ways, as David said, using his words, I think I'm paraphrasing correctly, looking in the couch pillows, right? The couch cushions.
Couch cushions.
Right now, Congress is looking everywhere. If they're trying to find $3.5 trillion in revenue. And in order to find $3.5 trillion, they're really scouring, all the couch cushions, looking under the couch, going through the winter coats. They've got to look everywhere.
Yeah.
But yeah, so just pivoting back to the IRA provision, and I'll very
sorry to take you off. Sorry to take you off course. I'm sorry.
Investment piece, but the other piece really hits everyone. Where if this bill passes as proposed, folks in their IRAs will no longer be able to invest in investments that require, any representation about their wealth, their income level, their education level, or their certifications. And this is a big deal because, traditionally in a 401k plan, it's a bit of a walled garden where fiduciaries pick the options that you can invest in. And then IRAs then provide an avenue for, further diversification through the use of different products. And this provision essentially would strip the ability of individuals to use their IRAs for that further diversification away from things like mutual funds. So this to me is kind of a massive deal. And lastly, they're putting restrictions in place in your ability to invest in your own company. So one form of capital formation for starting a small business would be, investing alongside your IRA or using your IRA to start a business. And essentially what Congress is saying is, you can't do that going forward. And, for farmers, for small business owners, for other Americans, that could be a really big deal, as it could impair capital formation in particularly the small business sector.
Well,
and Jeff,
yes, sir.
Jeff, can I throw one more item in?
Yeah, hit me with it. Hit me.
And let me give one other easy example. Like defined benefit plans. We all know that they've shrunk, but you do see one of the areas that you see growth in DB plans, interestingly, is small business. Why? Because the owners want to put more money away from themselves. Some is altruistic, paternalistic. Some owners are just looking to be more broad-based. Regardless, because of the non-discrimination rules in the Internal Revenue Code, those DB plans often wind up generating benefits for other employees in the company, which helps not the owner for retirement. And someone's going to say, well, 10 million is a lot of money. People will still do these. Maybe. But as you start to reduce the amount of money that the people designing these plans can do, they get less interested in these plans. And what's to say if we need money next week, we don't go from a $10 million cap down to a 5 or a 3, and you keep saying, well, that's not still a lot of money. It keeps going down the hill. So it's important for people to realize, just because it may not affect you today, it could affect you tomorrow, and that's why we care.
Yeah, absolutely.
And David and Jeff, I know we've gone long this week. I mean, to me, this is really an important issue for the retirement system, and listeners, it's worth looking into. And if you view this as a big issue, it's worth finding a way to communicate. And I don't normally advocate here, but it's worth finding a way to communicate to folks who can get in touch with Congress on if it impacts you.
Absolutely. Well, David Levine, this is an important topic. I'm so glad that you were able to join us, and I want to wish you a great weekend. I guess we're going to have to revisit this topic next week in the coming weeks. Hopefully, maybe we'll even do a special if something happens to break in between now and then. Gentlemen, have a great rest of your weekend. Pleasure to talk to you as always, and we'll talk to you again next week.
Thank you so much, John.
Bye, guys. Welcome back, and now we're going to talk a little technology, consumer goods, all things in between. Joining us on the line, he is the lead advisor and executive producer for 7 Investing. We're talking about Daniel Klein. Dan, thanks so much for joining us on the program this morning.
Good morning, Jeff. Happy to be here.
Hey, I got a question for you before we get into our topics. 7 Investing, are there just 7 people that work there?
So there are 7 advisors. Each of us makes a stock pick each month. We give you our highest conviction long-term stock pick. But no, we have a full-time marketing director. We have a couple of part-time people in production and marketing. But there's maybe 12 of us, a couple of people that work on transcriptions from our videos, but a very small, very tight team.
Okay. Thank you for clarifying that. It's something that's been kind of eating at me. I just wanted to know that detail. All right, Dan,
If we add another person, we have to change the name, and that gets very expensive.
So, I was going to say that's pretty branding, all that kind of stuff. You become 8 Investing or 9, 10, Okta Investing. Okay, Dan, let's talk about, are we ready to say goodbye to passwords? Hey, look, I can tell you, we've talked a lot about cyber on this show with you and others. Passwords, pain in the rear end, people can get them.
Yeah, it's funny. You mentioned this, but we were originally going to tape this with me driving. I'm coming back from a trip. I got back a little sooner, so I'm actually doing it at home. And I had to log into, I don't know if we promote what we use to record it, but I had to log into it. And I couldn't remember my password, and I'm driving, and I didn't want to reset it, and it took a bunch of times. It's frustrating. And what Microsoft is doing, and they're really leading the way, is eliminating passwords. And we've started to see this. Like, so Jeff, I knew you're an Apple guy. I'm doing this on a Mac, and when I'm wearing my Apple Watch, which at the moment I'm wearing a Fitbit because I was away, and the Fitbit doesn't need a battery as much. It doesn't need to charge. But when I'm wearing my Apple Watch unlocks my phone. We're moving more to a world, and Microsoft is really leading the way with this, where things like, your retinal scan or your thumbprint become your password. And look, it's safer and it's also easier. Like, I don't know, my password's always like some combination of like a sports team and my cat's name and a number and an upside down question mark. Like, it's just like so difficult. So yeah, I think we are finally moving to a world that actually has better security because I'm sure you know this. Your fingerprint is just yours. Your retinal scan, we've all seen it in movies where they have to like take the guy's head with them to get into the thing. I think we're seeing much more of that. And look, we've talked about it a lot. We live in sort of a nefarious world. I mean, I am not entirely sure that putting your hand over the keypad while you're putting in your PIN at the gas station is the top tier security. Imagine when you could just like look at it and it knows who you are. Now, obviously, there's ways that can go wrong, but I do think when you have a Microsoft, which is obviously a gigantic company, sort of, Windows is by far the leading operating system, saying, yep, we're going to make this an option. That pretty much means it's coming. And look, we've had this on our iPhones for quite a while, where it's been a facial scan, and you have the option of also typing your PIN code in. But this is a really big leap forward. I mean, think how long the entire digital era we've been using passwords.
Yeah, things just popped in my head. I just want you to know, Dan, today I was doing some checking on my iTunes account and I forgot my password for the umpteenth time and I had to reset it for the umpteenth time. And, I always have some type of derivation for my passwords, and it is hard to manage. It is hard to. I think a lot of people struggle with this, and so going back to what you mentioned before about, I guess you have to carry someone's head to do the retinal scan, right? We've seen a Demolition Man. I think they do that with the guy's eye because they use an eye to. I mean, no system is completely infallible.
No, of course not. My favorite is there's a Simpsons episode where Homer goes through all these different scans and then he gets in and on the other side of the room there's a screen door that's open. Like sometimes you could be as safe as you want and things just aren't going to work out. But it is better because look, we know that Americans are not good with passwords, that there's way too many people, where their password is like their kid's name and a 1 or it's password 123. Like that's really dangerous. We've seen and be really careful if you're on social media. There are those like questions like what's the name of the street you grow up on? It's like, well, they're trying to find your password. Like there's a lot of stuff that seems innocent because most of us do base our passwords on things. And obviously, there are, some of my phone only passwords. I use the like auto generated one where it's like 8 billion characters that have no rhyme or reason. But most people don't use that. Most people are using, their favorite sports team and a number or something like that. So this is better. It's safer. And, we're under a constant sort of security threat. So this type of thing, I think, is really, really important.
Dan, let's shift gears. Apple had a big announcement this week. New iPhones, new iPads. There's a mini and a new generic iPad. And there may be some other things that I didn't watch the whole thing, Dan. I don't have time to do that. But I want to get some rapid reaction from you out of that. And is it worth upgrading to a new iPhone?
So absolutely no, but of course I am going to. So here's the problem. This, it is the new iPhone 13, and there was some talk
Lucky
that they
13.
wouldn't use. Yeah, there was some talk they wouldn't use 13, but like I don't know. I always feel like when you're in a building that goes like floor 12 to floor 14, when you're on 14, you're on 13.
Yeah,
like it doesn't really change anything. So calling it like the X3 or something wouldn't have done it. But yeah, this is very underwhelming. I basically said it's the announcement where they announce all the things that aren't true. Like they tell you the battery lasts an hour and a half longer, the camera's better, and like I don't know, the camera's been better and the battery lasts longer for like the last 5 iPhones. And you know what? The camera doesn't matter and the battery's not better. Like as much as the battery gets better, like the things you use end up taking more power. So no, I think this is underwhelming. This is sort of the off year. Apple tends to have a 2-year cycle where every other year is, no major change to the form factor. So for most people, I think this is an upgrade if you're due, because there do appear to be some pretty strong incentives from the phone companies for trading in. And if you don't have a 5G capable phone and you travel or live in someplace that has 5G, I will say that a lot of West Palm Beach where I live has 5G. And if, like, I don't know, like my wife's doing something and I'm waiting in the parking lot and you have 5G, like you can watch Netflix at like you can on your home internet connection. So there are some things that are nice, but I would look, if you're not someone who needs the latest and greatest, I would look at what the deals are on the iPhone 12 and what deal you could get on a 13. The prices are stayed the same, so obviously the old one gets cheaper. Nothing special. New iPad mini, again, specs that just don't do anything. Apple's in a tough position because they have to innovate, and sometimes they just can't. Like, there were a lot of rumors with the new Apple Watch that it would measure, blood sugar and your not just your heart rate, but your blood pressure. And the reality is, to do that, you actually need to be certified as a medical device, or it's just like for entertainment purposes only. So those are things that they might be able to do someday, but it's not as simple as knowing how to do it. There's a lot of approvals. So yeah, pretty underwhelming, but Jeff, I'm an idiot. I'll buy one on the first day.
Well, I think you have a kind of a vested interest or importance of doing that because you're always testing and commenting. Dan, let's just going back to that other issue that you raised, and are we at a point where there's just saturation, whether it's Samsung, which is a great phone, whether it's LG, another great phone, or Apple? We just need to lower our expectations that the thing is not going to dance, or it's not going to do the hologram like with Princess Leia and R2D2. It's not. We're not there yet, and so until we get to that technology, and you can say, help me, Obi-Wan, you're my only hope. We shouldn't have these high expectations.
I'll look at it in a more positive way.
Okay, I'm negative, I guess.
Well, we've democratized some pretty amazing technology. Like, remember in the BlackBerry days where like having a BlackBerry meant you were like successful, even if it didn't really? Now, really the lowest end of being able to afford a phone, buying like, a $200 Android phone, that's like a pretty powerful computer in your pocket that can do a lot. So, I think of it from like the parts of the world where computers aren't as common, where, internet connections aren't as good. I was just in the Bahamas, and like, you can get a very basic phone in the Bahamas and have access to things that like previously were unavailable. So yeah, no, the new iPhone won't make me an espresso. It won't do holograms. But I'm sure there's 3 things I haven't thought of that it will do that'll be kind of neat. And just the fact that everyone, look, our like 6th graders have phones that 10 years ago only like a high-end businessman would have. Or I remember my dad used to have this like bag with a cell phone in it for when he traveled. That was like the size, it was like the size of a suitcase. Mm-hmm. Like, so the days are just very different. And look, you and I are old enough to remember we were in college together, which we learned a few weeks ago. I didn't have a cell phone. I had a phone in my room, and like people left me messages. Like, we've come a long way, and now this technology, like, you don't need an iPhone 13. An iPhone 6 or a basic Android is still really, really impressive.
Yeah, really interesting. And like I said, I think it's just we've reached this point, where the technology just doesn't have as much of an impact. So I guess Apple's going to have to look to reinvent and do different things. Dan, we're going to have to leave it there. Always a pleasure chatting with you. Really good stories this week, and we'll wait to hear whether you become 7 investing, 8 investing, 10 investing, or 100 investing.
Too many people for our Slack. I'll see you next week.
All right, take it easy, Dan. Bye-bye. Welcome back, and now we're going to end the show taking a look at markets, and markets are an important part of retirement savings. Joining us, and he just walked off the set of his show, Morning Trade Live. I'm talking about Oliver Rennick. He is lead anchor for the TD Ameritrade Network. You can find him on TDAnetwork.com, I think is where your site lives, right?
TDAmeritradenetwork.com.
There you go. Oliver, great to talk to you as always. Thanks so much for joining us this morning.
For sure. Thank you.
All right, so you just walked off set. I'm sure you have all the latest data at your fingertips, and you're not tired of talking with other guests. Let's break it down for the audience. What's happened this week? I think we've had some muted returns, to use a technical term, but why don't you give us a skinny?
So last 3 weeks or so, really about the past month, the narrative that I've been leading our coverage with on the network is rotation or bust. Basically what that means is that the market looks like it is on the verge of a major leadership shift, or perhaps the first serious breakdown we've seen in quite a while. The reason for that is just because the economic backdrop is at a really critical juncture where the data that's been missing expectations and softening for the last 3 months has largely been attributed to the impact of COVID resurgence through the Delta variant and how that has caused complications for the economy. So as the COVID curves start to slow down, we hope, and it looks like there's a good case to be made that those curves are peaking, we're going to find out how much potential energy is built up in the economy waiting to be released again. And if there is a lot of potential energy that can create another economic bounce back, then you should have a very different looking stock market than what we've got in the last 3 months. And that would mean that instead of tech companies and growth oriented stocks leading the market and big mega cap tech, you would think that businesses dependent on the economy or the reopening would be the leaders. And if that doesn't happen, then there is a possibility some of the economic slowness we've seen is due to factors other than COVID, and that would be a bad thing for the market. So it seems like either we are going to get that leadership shift or we're just going to get broader downside. So far, it looks like it's still a tough call, frankly. So far, over the last 10 days, we've just seen more general downside. So far, it's kind of looking more like just general weakness as opposed to real rotation. But if you wanted to get real specific, technically speaking, over these past 10 days, businesses tied to the economy have been holding together a little bit better. If you look at banks and to some degree, some of the reopened trade, airlines have actually been quite steady over the last 2-3 weeks. So the market is at a period where it's trying to figure out what it's going to lead it next. And that's what we're watching very, very closely right now as tech in particular starts to slow down its incredible ascent that we've been watching for an entire quarter.
It really is amazing just to watch that particular sector, and it's done so well over the course of this pandemic as we're all working from home, Oliver. Just historically, can you take us back when you look at the fall? If this wasn't a pandemic, has the fall time period, the autumnal equinox, has this been a time of slower aspects of the market, and maybe this is kind of this rotation, if it is rotation or bust? Is this typical, and we have to kind of factor that in?
Absolutely. September is a seasonally very weak month for the market, so that's totally reasonable factor to include, and a good point and good knowledge there, Jeff. The seasonal returns there for September are particularly low. By some standards, one of the worst months of the year. So we have to keep all these things in mind. But at this point, looking at some of the really important macro trends, there's probably something bigger happening here. Just because if you look at the 10-year and the dollar in particular, they're trying to change course. And that's really, really important because these particular assets are going to be, I think, the most honest tells in the market about how this all shakes out. And what's happening right now is the dollar, for the first time in 18 months, the U.S. dollar is trying to break out to the upside and go higher, which is very much a view that is out of consensus and was out of consensus coming into this year. So that dollar moving higher is representative of some combination of, economic strength, but also the Fed tapering and removing some support for the market and setting the stage for perhaps interest rate hikes at a faster pace than people expected. So that's another very crucial point to this. Yields trying to push higher and bond yields trying to push higher. If the 10-year gets through 1.4%, then it opens up room to potentially push back to 1.5, and then from there you're looking at a really interesting trade again that is a difficult one for stock investors, because we've seen in the past when the yield goes higher, it creates a lot of complications for tech investors in particular.
Last question here, Oliver. Yesterday, unemployment claims rose slightly. How do you reconcile that, or how does the Fed, maybe not you in particular, although I'd love to have you, making Fed policy, and maybe as the chair, I'll put you up as a nominee for chairperson. But how do you reconcile that? I mean, we had seen a pandemic low the previous week, but now we've seen a little bit more in terms of Americans seeking unemployment benefits. And I'll posit that to you by saying that we've got all these people all these jobs that are out there. So I'm trying to figure this out and rationalize it, and then compare it to market results, because you would think that people would want to get back to work and do something. I don't know, just me.
Absolutely. Well, there is a big gap, right, between those available jobs and the number of people looking for jobs. So indeed, you would think that would start to put some upward pressure on wages in particular. Right now, there is definitely a mismatch in terms of skill sets, I think, but there's also a mismatch, very importantly. Well, just the skill sets part, a lot of people retired early, and then, of course, unfortunately, a lot of death in the world. The workforce has changed. So there's definitely a mismatch in capacity from a skill perspective, even though there might be very much capacity from a numbers perspective in terms of people. But there's also definitely a mismatch in terms of expectations for wages and the hesitance to take those lower paying jobs in an environment where you can make $40 an hour driving Uber right now in a metropolitan area. That is just going to, skew things away from $15 an hour jobs or service jobs that are paying minimum wage. But eventually that gap should close. But it's difficult to understand so far how it relates. There's not a lot of very compelling evidence in either direction that should give us some particular confidence in understanding how the stimulus checks and how the expectations of support from the government have changed people's expectations for jobs. We don't really know yet. Some things might make sense logically, but other things have shown up so far in terms of areas that dialed back those unemployment benefits earlier, and there's not a big difference from the overall market. So it's just really unknown. That is the great unknown. But my conclusion right now is that it is largely most likely to be an inflationary force, because there's probably going to be wages that have to go up, and those wages are the sticky point for inflation. So it all kind of comes back to expectations for the Fed.
Yeah, and it's like everything else with this pandemic. It's so fluid. It changes day to day, and we won't ever be able to tell the impact of all this. I think we're going to be looking at it years and years from now and saying this is what actually happened, just like we did with 2008, just like we did in the 1970s with stagflation, and we did with the Great Depression. Oliver, we're going to have to leave it there. Really great analysis as always. People certainly check you out. Markets, Morning Trade Live and Markets on the Close, the two shows that you anchor, and you do a lot more for TDA Network that people should certainly check out as well. So enjoy the rest of your weekend, and we'll talk to you again soon.
Thank you. All right. See you, Jeff.
See you. Bye-bye. And that wraps up this episode of BRN Sunday. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the information in retirement, markets, technology, personal finance, so much more, check out today's edition of our daily newsletter, The Morning Pulse. We're back again tomorrow. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.